Imagine dedicating your entire life to hard work, saving, investing wisely, building security, only to discover one morning that everything you've earned is slowly slipping away. Not from theft, not from taxes, but through an unseen mechanism designed to drain your wealth without you ever realizing. This is financial repression, one of the most subtle yet powerful tools governments use to steer economies, pay their debts, and maintain control. Most people have never heard the term, yet it has quietly shaped your financial life from the day you opened your first savings account. Before we dive deeper, drop a comment below. Tell me where you're watching from and what time it is for you right now. It's incredible how these stories connect across borders. And if you're here because you want to understand how the system truly operates, not the filtered version, you hear on the news, hit subscribe, because what you're about to learn will forever change how you view your savings, your retirement, and your idea of financial freedom. To grasp financial repression, start with one basic truth about governments. They always spend more than they collect. They borrow to fund wars, welfare, rescues, and re-election promises. And that debt almost never disappears. It just swells quietly, year after year. But here's the dilemma. When public debt grows too large, governments have only two escape routes: default or debasement. Default is open suicide. Inflation, by contrast, is elegant. It looks like rising prices, but it's really the slow transfer of private wealth to the state. That's where financial repression enters. It's a deliberate strategy combining low interest rates, high inflation, and restricted capital flows to shrink the real burden of debt, all while locking savers inside a system designed to lose. Here's how the mechanism works. You deposit your money expecting interest, but in a repressed system, governments and central banks cooperate to hold rates artificially low, often beneath inflation itself. So if inflation runs at 4% while your account pays 2%, your purchasing power falls by 2% every year. You're not earning income. You're paying a hidden levy, and unlike ordinary taxes, there's no vote, no policy, no announcement. It just happens. Each year, your money quietly buys less. Meanwhile, the government's towering debt shrinks in real terms. Savers, retirees, and pensioners carry the loss. It sounds conspiratorial. It isn't. It's official policy. After World War II, both the US and UK used financial repression to melt down their enormous debts. Central banks pinned interest rates far below inflation for years, while laws forced pensions and banks to hold government bonds, ensuring endless cheap credit. Savers were trapped. Their returns lagged behind inflation, yet they had no alternative. By the 1950s, debt to GDP ratios had collapsed, not through repayment, but through silent erosion. This was the genius and cruelty of the design. The pain spread thinly, invisibly across millions of ordinary people. No riots, no collapse, just a gradual siphoning of private wealth into public hands. If you lived through it, you wouldn't have seen theft. You'd only have noticed life growing costlier, and your savings stretching less each year. Fast forward to now. Global debt stands at historic highs. The US owes over $34 trillion worldwide. Debt exceeds 300% of global GDP. There's no credible way to repay it. So what happens next? The same formula governments have always used. Suppress rates, expand money, and let inflation do the cleanup. When central banks cut rates to zero in 2020 and unleashed oceans of liquidity, they didn't just rescue markets, they rebooted the system. For debt-heavy governments, this is paradise. Inflation runs at 5% or 6%. Wages inch up slowly. Savers bleed quietly. And the debt, measured in real terms, gets lighter. You might think, I'll just invest in stocks or real estate. That's exactly how the system channels you. When cash burns, people flee into assets. And in doing so, they inflate the very markets that sustain the illusion. Rising asset prices make households feel wealthier. They spend more. The economy spins faster. But here's the catch. Those who already hold assets win the most. The wealthy climb higher while everyone else runs harder to stay still. It isn't random, it's architecture. This is modern capitalism, engineered on inflation, debt, and quiet financial repression. So why not simply raise rates and end the cycle? Because doing so would detonate the entire structure. Governments can't afford expensive interest. Rates. Every single percentage point hike adds billions in extra payments on public debt. That's why central banks insist inflation is temporary. Even when evidence screams otherwise, they know the truth. They can't crush it without bankrupting themselves. So they let it burn. And while it burns, your savings smolder with it. The cruelty lies in the disguise. They tell you inflation reflects healthy growth. They claim low rates encourage innovation and investment. They assure you everything is under control. But beneath the polished statements hides the real agenda: devalue the debt, trap the savers, and prevent any escape. Capital restrictions make it difficult to move your wealth abroad. Regulations force banks to stockpile government bonds. Financial markets reward risk-taking. Not prudence. It isn't chaos. It's orchestration. This isn't a modern invention. It's an ancient policy dressed in digital clothes. Only now it's planetary. From Washington to Tokyo to London, every major central bank runs the same program, and every worker, saver, and investor lives inside the same invisible cage. To understand how deep this playbook goes, study history's largest experiments in financial repression. After World War II, Britain's debt exceeded 250% of GDP. It couldn't erase that burden through productivity or taxes alone, so it turned to inflation. Between 1945 and 1980, prices climbed over 6% a year on average, while bond yields sat under 3%. That gap, the spread between inflation and returns, quietly erased half the nation's debt in real terms. There were no Jubilee announcements, no sweeping defaults, only decades of invisible confiscation. Officials pretended to shield savers, but in truth, they harvested them. The strategy thrived because few understood it. Bank accounts still showed the same numbers, only purchasing power disappeared. The United States ran the same experiment. After the war, America's debt topped 120% of GDP. Instead of austerity, policymakers embraced what economists politely call financial repression. By capping interest rates under Federal Reserve policy, they guaranteed inflation would outpace yields. From 1946 to 1956, real interest rates stayed negative nearly every year. By the decade's end, U.S. debt had dropped below 60% of GDP, not through discipline, but through stealth taxation. Every saver paid for the government's wars without ever knowing it. That's the brilliance and brutality of financial repression. It uses inflation as the weapon, low interest as the trigger, and public trust as camouflage. Governments appear responsible while silently draining private wealth. And because the pain unfolds slowly, there's no revolt. People adjust. They blame corporations, markets, or misfortune. They rarely see that the extraction is systemic, by design. The same method is operating now. Since 2008, central banks worldwide have printed over $30 trillion. They label it quantitative easing, but that's a euphemism. It's pure money creation. New currency flows first to banks, funds, and governments. By the time it trickles to households, prices are already inflated. The outcome is predictable. Asset inflation at the top, cost of living inflation below. The rich watch portfolios multiply. Savers earn nothing. The middle class shoulders the weight. Their wages trail. Behind, their rent surges, their retirement shrinks. You might ask why people don't rebel. The answer lies in psychology. Inflation confuses. It isn't a single event like a new tax. It creeps. It's the quiet theft of value, the erosion of memory. You can't pinpoint the moment your money lost meaning. It just fades until one day you notice the emptiness. That's why financial repression works so well. It doesn't resemble theft. It feels like misfortune. The entire policy, depends on quiet obedience. People must keep their wealth inside the system. That's why governments and central banks discourage escape routes, alternative stores of value, hard assets, or independent money. They ridicule gold as outdated, dismiss Bitcoin as gambling, and regulate capital so your wealth can't leave. In the 20th century, nations like Britain and America even outlawed private gold ownership. Now, they use oversight and digital surveillance to track every transaction. You're free to save, but only in the assets they oversee. And let's be clear, oversight is the objective. Financial repression isn't merely about managing debt. It's about dependency. When citizens rely on the state for stability, control becomes effortless. You work. You save, you pay your dues, and the system reclaims its share without asking. The state no longer needs to confiscate property or raise taxes openly. It simply adjusts the value of money until the outcome is identical. Take Japan, for example. For decades, Tokyo has kept interest rates pinned near zero. Savers earn almost nothing while inflation stays. While that policy allows Japan to sustain debt above 250% of GDP, the highest among developed nations. Japanese households still believe they're secure, yet their purchasing power has flatlined for a generation. Their savings fund the government, not their future. And because domestic institutions dominate the markets, escape is impossible. The same play unfolds across Europe. For nearly 10 years, the European Central Bank kept rates below zero. Pension funds strained. Retirees were pushed toward riskier bets. Governments borrowed freely. Toward riskier bets. Governments borrowed freely. When inflation surged in the early 2020s, it was already too late. Rates rose. But debts had multiplied. The machine trapped itself. Central banks couldn't normalize policy without triggering collapse, so they accepted inflation as the lesser evil. For ordinary Europeans, that meant higher prices, smaller pensions, weaker savings, the silent cost of preserving the system. Now imagine this operating globally. The United States issues the world's reserve currency, so its actions echo everywhere. When the Federal Reserve suppresses interest rates, it doesn't just affect Americans, and it pulls the entire planet into the same vortex. Emerging. Markets watch their currencies sink. Capital rushes toward the dollar, foreign debts grow heavier. The result is a global structure of repression, built not on violence, but dependence. Every central bank takes its cues from Washington. Every investor watches dollar signals. Every saver holds assets that decline in real terms. Financial repression thrives on belief. Politicians and economists swear it's temporary. It never is. Once a government becomes addicted to cheap debt, withdrawal is impossible. Every downturn justifies more stimulus. Every crisis excuses more printing. The longer it lasts, the harder it is to stop. And step by step, your purchasing power evaporates. Here's the cruel irony. The system praises virtue while punishing it. You're told to save, to invest wisely, to be patient. But in a repressed economy, prudence becomes a penalty. The reckless speculator prospers. The disciplined saver bleeds. That's the moral rot at the system's core. It rewards manipulation, not creation, speculation, not substance. So trust erodes, and when trust fades, money follows. Make no mistake, the structure is unstable. Financial repression can endure for decades. But it always ends the same way: collapse. Inflation destroys faith. People seek exits. And when enough do, control disintegrates. That's when history turns violent. Every empire that mastered repression eventually met its reckoning. Rome debased its silver to fund endless wars. At first, citizens ignored the dilution. Prices crept upward. Soldiers stayed paid, but confidence decayed. Merchants demanded more coins for the same goods. Legions refused worthless pay. Trade disintegrated. What began as clever accounting ended in ruin. The pattern repeats in modern times. Corrupt the currency, and you corrupt everything tied to it. Trade, savings, trust, and eventually civilization itself. Modern governments think they're immune. They believe spreadsheets. And PhDs can outsmart arithmetic, but the math never changes. Every time real interest rates sink below inflation, collapse is seeded. The only question is how long it takes to bloom. After the pandemic, we saw the perfect storm. Trillions in stimulus flooded the global economy. Central banks held rates at zero. Inflation roared. At first, officials dismissed it as transitory. By the time they admitted the truth, the damage was done. Savers had lost years of real returns. Housing, energy, and food exploded in price. The middle class, already strained, was crushed between debt and cost. Here lies the unspoken truth. Inflation isn't a mistake. It's a method. When governments drown in debt, they need inflation to shrink the weight. They just need it to rise slightly faster than interest rates. Not enough to incite panic, just enough to quietly drain wealth. It's a tightrope between deceit and disaster. But history teaches one certainty. That balance never lasts. Sooner or later, inflation breaks free. People rush into hard assets. Land, metals, energy, Bitcoin. Anything the state can't conjure from nothing. And once faith fractures, no command can rebuild it. Financial repression survives on illusion. The illusion of balance, the illusion of control. As long as citizens think the game is fair, they keep playing, but when they finally see the rigging, they search for exits. That's when policymakers panic. They roll out capital controls, wealth levies, and digital restrictions. They claim it's about fighting crime or protecting the system. But the real motive never changes: to trap. Capital inside a collapsing currency. The rise of central bank digital currencies, CBDCs, is the next chapter in that evolution. With programmable money, authorities could impose negative rates instantly, restrict purchases, or even expire your savings to force spending. It's the ultimate weapon of control, a financial cell wrapped in convenience. Think about it. In the past, when banks paid nothing, you could withdraw cash and hold it yourself. That physical escape kept a floor under rates. But in a cashless world, the door is sealed. Every dollar, euro, or yen becomes traceable, taxable, and if required, erasable. Governments could drain wealth silently. At the speed of code, combine that power with inflation, and control becomes absolute. A world where citizens own nothing solid, where every asset melts like ice in the sun. We've seen this before. In the 1970s, after decades of suppression, the dollar's link to gold finally broke. Inflation surged, interest rates spiked, and the illusion of stability shattered. It took brutal recessions and double-digit yields to restore trust. But here's the warning. Today's debts are far larger, and today's citizens far more dependent. A return to honest rates would bankrupt governments, detonate markets, and annihilate pension systems. So instead, policymakers will dig deeper. More stimulus, more printing, more control. They'll promise price stability while quietly dissolving your savings. For ordinary people, it creates a cruel paradox. You're told to save, yet savings decay. You're told to invest, yet markets float on manipulation, not productivity. You're told the system is just, but it punishes restraint. So what can you do? Awareness is step one. Once you see financial repression for what it is, a stealth tax on savers, you can adapt. Diversify beyond fiat money. Hold assets anchored in reality. Commodities, productive land, businesses that create tangible value. These aren't just investments, they're lifeboats. But beneath the economics lies a moral question. What happens to a civilization when honesty stops paying? When prudence is punished and speculation exalted, that's where we stand now. A generation raised to believe leverage, not labor, makes wealth. Governments celebrate it because bubbles feel like progress. But illusions always rupture. Every suppressed rate is a postponed crisis. Every printed dollar is trust borrowed from the future. And someday, the invoice arrives. In truth, financial repression isn't the disease. It's a symptom. The disease is cowardice. the refusal to confront debt with discipline, to speak truth to voters, to accept limits. Printing and repression are shortcuts, and every shortcut ends at a cliff. The victims aren't the powerful, they're the savers, retirees and workers who did everything right. Their wealth is siphoned upward, and when collapse comes, they're told it was unforeseeable. But math is never surprised. Zoom out, and the pattern is unmistakable. Whenever debt smothers an empire, inflation follows. Whenever inflation corrodes trust, control tightens. And whenever control reaches its peak, people find a way out, a new currency, a new order. A new dawn, Rome fell. Britain's pound lost its throne. One day, the dollar will face the same reckoning. The question isn't if, it's when. So next time you hear a central banker insist inflation is contained or rates will stay low, understand what they're confessing. They're revealing the plan. Your savings are the collateral. Your future is their balance sheet. And the longer you remain inside their game, the more you'll lose. But here's the light amid the darkness. Knowledge is leverage. Once you grasp how repression works, you can live beyond its reach. You can build real value in skills, in assets, in relationships that no decree can devalue. That's the quiet rebellion. The system thrives on ignorance. It fears awareness, because once people recognize the cage, they stop mistaking it for safety.